Hey guys, how you doing? So Dan from Trading with Dan here. So you guys may or may not be aware of the volatility that's going on in the gold market at the moment. And if any of you guys out there trading gold, you may have noticed the other morning, yesterday morning, that we had pretty wide spreads on the futures of $18 was the widest I saw it. So you could basically, the difference between the price you could buy gold at and the price you could sell gold at was $18, which is a ridiculously large spread. Bearing in mind, it's usually like 0.1, $0.1, so like a 10-cent spread, sometimes even less. So it was a massive difference. So so we've got some issues, some problems in the gold market at the moment. It's been going on for a while, more so with physical silver, people not being able to get hold of silver ounce coins, and now it's starting to happen in the gold market where people aren't able to get hold of the physical underlying asset at the price the spot market is saying it is meant to be. So yeah, if we just have a look at this chart, this is the gold chart. You can see since getting to that peak of 1700, we have had quite a large sell-off. As you can see, we had a sell-off down here of about 14% over a good few days. But as you can see here on this one day here, we had a rally of what was 10% in one day, and pretty much $153 move here. And that is an insane amount of one day volatility in the price of gold. So we're gonna have a look through this article, see what they say about. The gold market is breaking down. Gold spreads explode, which is what I said about the gold spread, explode as LBMA warns of liquidity problems. So that's the London Bullion Market Association, I think it stands for. That's right. So anyway, so last night, when observing the unprecedented gold run on precious metals dealers, which has left all gold vendors with little or no physical gold, we said that the price of physical gold has decoupled from paper gold as a result of paper gold liquidations, as leveraged funds scramble to cover margin calls using safe assets. So what this is saying here is that if you're holding the paper asset that's traded, which what governs the spot price, you've got traders that are offside, traders, banks, institutions, hedge funds that are offside on other positions, i.e. losing money, and they're having to then sell their gold paper positions. By paper I mean it's like a contract, it's like on the exchange, it's not actually, they don't hold the physical gold there, they just hold a contract, i.e. a long contract, the long gold. So they're having to sell those to release funds, to take those profits, to release margin, to then cover other losses that they've got elsewhere. And then that driving of the price down on the physical, on the spot markets, so the futures markets, the trading markets like the ETFs and the spot markets, they are basically not giving like a price reading that matches the actual physical supply and the demand for physical supply. So there's a premium on top of what that price is basically. So this results in an arbitrage that physical gold buyers, i.e. those that don't have faith in gold ETFs such as GDX, or simply prefer to have possession of the metal, find it especially delightful as it allows them to buy physical gold at lower prices than they would ordinarily have access to. However, we also noted that whereas in the past such conditions were self-correcting, this time it is not only a record surge in demand for physical gold, but also a near shutdown in supply, as most of the productive gold refiners, those located in the southern Swiss town of Ticnia, however you say that, namely Valcambi, Pamp and Olga, I'm rubbish at these names, now appear to be offline indefinitely. So yes, the refiners aren't basically refining gold at the moment. So as Kitco notes, just before noon EDT, one price vendor was showing the spot metal was trading at 1612 an ounce, while at the same time the COMEX April futures were trading at $1,654 an ounce, a spread of $42 an ounce. It was much wider than this earlier in the day when Kitco adds nearby futures were also more expensive than deferred, a sign of strong demand in any commodity market. I've never seen that before, said one gold trader who has been in the market for 30 plus years. Some contracts reached by Kitco suggested the discrepancy is some contacts reached by Kitco suggested the discrepancy is an evolving story that is still unfolding, with traders trying to figure out what is happening. Early in that day, the London Bullion Markets Association, London Bullion Market Association, that was right, LBMA, the world's most important authority for physical gold and its transfer, issued this stunning statement to Kitco. The London gold market continues to be open for business. There has, however, been some impact on liquidity arising from price volatility in COMEX 100 ounce futures contracts. LBMA has offered its support to the CME group to facilitate physical delivery in New York and is working closely with COMEX and other key stakeholders to ensure the efficient running of the global gold market. In short, the unprecedented scramble for physical metal, coupled with continued liquidations among levered players while refiners remain offline, appears to be fracturing the gold market from within. Saxo Bank's head of commodity trading strategy, Ole Hansen, observed that a lockdown is occurring in the two biggest gold hubs in the world, New York and London. So many traders are working from home, this has caused a breakdown in the marketplace, he said. There is no price discovery in the market right now, he said on Tuesday morning. If you need to borrow gold in the OTC over-the-counter markets right now, you're going to pay a king's ransom. So yeah, I'd just like to point out, we are having a breakdown in the markets at the moment, and massive arbitrage opportunities basically aren't being taken advantage of like they would be if the traders were literally there to take advantage of them. So such as the GDXJ, which is the junior gold mining ETF, was trading at a 20% discount to the actual NAV, which is the net asset value of the underlying companies that make up that ETF. So what that is saying is that you could immediately buy the GDXJ and then at the same time immediately sell all the individual companies on the stock market that are in the GDXJ and lock in an instant 20%. And the fact that that wasn't happening, it just shows it basically just shows that the guys aren't there to actually do it, to actually arb it out. So that's basically what they're saying about the markets not working. Right, so picking up on what we said last night, Hansen described the problems as a logistics issue as the coronavirus has decimated supply chains across the world, adding that the gold market has dried up because nobody has access to the physical metal. We don't have enough hands to handle all the demand, he said. There's plenty of gold in the market, but not in the right places. Nobody can deliver the gold because we are forced to stay at home. Or as we put it yesterday, if you haven't bought physical gold yet, it's probably too late. So speaking to Kitco, Rona O'Connell, head of market analysis for EMEA and Asia regions in Intel FC Stone, said the dislocations in the gold market is resulting of nervous trading and an increasingly thin marketplace. Not only is physical demand picking up in London, but three major Swiss refiners are shutting down operations, which is further putting a squeeze on supply. I think the price action we've seen is simply people guarding their risks, she said. O'Connell added that the price difference between the North American markets and London markets is also a result of the UK market being more of the physical gold market. The balance between physical futures is more geared towards the London over-the-counter market, she said. Speaking to several other traders, Kitco cites Afshin Nabavi, head of trading at MKS, who pointed out that traders from many banks are working from home due to the coronavirus pandemic. Meanwhile, these participants may be trying to limit risk, contributing to the spreads. So that's what I was saying. Basically, the traders aren't at their desks. to be trading and obviously providing liquid markets, so it means you're getting dislocations in the price. Phil Flynn, senior market analyst at Price Futures Group, suggested one of the reasons for high prices may be because of the market is anticipating future demand as a result of all the quantitative easing measures and expectations of fiscal stimulus. Oh dear, Phil, you don't want to tell people that. We got to pretend it's because the traders aren't there. Yeah, we don't want to suggest that there's all of a sudden going to be a large demand for gold, because cash is trash basically, and dollars are getting printed, pounds are getting printed, central banks are just basically got the printing presses in overdrive, and we don't want to be saying that. Futures prices may be a leading indicator of what may be a rush into gold, Flynn said. Yep, so I think that is more likely what's happening here. People just want to get the gold, get the physical gold, and because obviously having like say the custodian of some of these ETFs are the big banks that may be quite possibly going bust, especially when you couple that with the fact that like saying for America, for example, they're saying that you can't kick someone out, you can't evict anybody, so people basically aren't paying their mortgages. So I mean, we saw what happened in 2008 when people couldn't pay their mortgages. It collapsed the financial system. So if you have the whole country just not having to pay their mortgages, then you can see there's an inherent risk there to the financial system. Right, so separately, traders also pointed out that gold futures were in backwardation this morning, with April futures more expensive than the June and the December contract this morning. Although this has since reversed with the back months higher again, when nearby are more expensive, this condition known as backwardation and is the opposite of normal conditions in the commodity market. So why this is the opposite of the normal gold conditions is that there's actually a cost of storing gold. So the price of gold right now or next month will be cheaper than the cost in the future, basically because you got to pay for the storage costs of between now and that future point of when you buy the gold if you want it at a future price. So obviously if the price is actually higher now than it is in the future, which is called backwardation, that means that people are paying a massive premium just to get the gold now. And they just want it now basically. I mean, it's that simple. During regular times, later months are more expensive. Oh, they'll explain it now anyway. During regular times, later months are more expensive due to the extra costs such as storage. But when the nearby months are more expensive, this is seen as that traders are willing to pay a premium to get the commodity as soon as possible, which anyone who has been to COMEX or any other gold sale in the past few days has discovered. So what they're saying is anybody that is trying to buy any physical gold or silver is paying massive premiums. I mean, last week the premiums for silver were the spot price was about $12, and you'd have to pay between $22 and $24 to get a 1 ounce silver coin basically. Backwardation shows there's a lot of demand, with market participants worried about the economy and focusing on the response by governments and central bankers, Flynn said. People are buying gold like it's going out of style, he said. Or, as we first put it, it's selling like toilet paper, which is ironic because thanks to the Fed, Americans are fleeing the toilet paper money known as a dollar and rushing into real money as well as actual toilet paper. So that's quite funny really. So yeah, that's the end of the article. So that's what I wanted to explain to you guys. So obviously there is an issue with traders not being there, which are causing dislocations in the everyday function of the market. But let's not forget the underlying demand that there is there for gold, and that people are wanting to get their hands on the actual real physical metal that doesn't have any other that isn't a contract that has any other counterparty risk, that is a fully tangible asset. And yeah, so that's what's going on here in the gold markets, guys. So if that continues, obviously we're gonna have $2,000 gold soon, and it'll be up and away. But yeah, gold and silver markets, precious metal markets are suppressed down by central banks, because if they do go up, it is basically the most direct and clear signal that there is confidence is being lost in the fiat currency that basically it's priced in. So anyway, so there we go. So thanks for listening to that, guys. I've got another video coming up soon. and I'll speak to you guys soon. Oh yeah, remember, it's not a financial advice. I'm not a financial advisor. Always do your own research. I'll put the link to this article in the description, and I'll speak to you guys soon.